Hey there, everyone. Welcome to Chart This with Dave Keller. It's Thursday, March 13th. I'm your host, Dave Keller, coming to you from a beautifully cool and overcast Redmond, Washington. I'm just so thrilled to describe this place weather-wise as not raining, which is the normal sort of environment in these parts this time of year. Although it did rain earlier for about an hour, it kind of lightened up, and now we're back to just kind of cool and overcast here. Big red moon tonight. Those of you, in most places, but certainly in North America, most people have a chance, again, with the overcast conditions. I'm not sure about us here in Washington State, but could have an opportunity to see a pretty cool lunar eclipse if you've not caught that after dark Eastern time. And I would say, as we talk about the solar conditions, or I guess sky conditions and what they're looking like tonight, I have to compare that to what I'm seeing with the markets now here. It certainly feels like a wintry sort of decline. I'm thinking back to some of the Kondratiev seasons, fresh in my mind after talking with Ryan Redfern for the Market Misbehavior podcast earlier. We actually just released that episode yesterday from Shadow Ridge Asset Management in Austin, Texas. And Ryan and I talked about the kitchen cycle, which is a 3 to 5 year cycle that is pretty well documented. It was actually created in the first designed or identified in the 1920s. And here we are over 100 years later, still recognizing the consistent patterns in this kitchen cycle. So make sure you check out that episode. It was just released yesterday on our YouTube channel. Interviewed earlier today, Doug Ramsey of the Luthold Group. Luthold Group has a wide following in the institutional community. They publish this monthly research book called The Green Book, and most institutional investors, equity investors that I've worked with, are familiar with Steve Luthold's work and have probably read it for quite some time. Steve passed away years ago, unfortunately, but Doug Ramsey is now the CIO of the Luthold Group. Had a really cool conversation about how to make sense of this particular market. You know, how they're thinking about positioning, which is more hedging positions that they're keeping on as opposed to going completely defensive, which I thought was a really good sort of different way of thinking about a corrective move like this. So a lot to think about. With that in mind, let's talk about the market conditions here and how they played out. Where do we go? That's not it. Here we go. There it is. All right, let's look at the market conditions and how they played out today. Not great is the answer I would tell you. Even though the rain held off here for most of the day in Redmond, Washington, the rain not holding off market-wise. The S&P essentially finished at the lows of the day. There was this kind of late-stage rally around 2 p.m. Eastern, and all of a sudden it looked like, ooh, are we going to regain and just sort of, continue to strengthen into the close? The answer to that is no. In the 3 p.m. hour, which is, again, another concern. We've had a couple days now with a nice rally in the 2 p.m. hour, and then a sell-off in the 3 p.m. hour. Why does that matter? Because that last hour of trading is where a lot of institutions actually make their trades. Earlier in the day, you just have a greater chance of disrupting things, right? Of creating issues, creating instability, especially if you're trying to move a lot of volume. So usually wait till last half hour of trading to sort of minimize the market impact and just sort of wrap things up right before the markets are closed. So last 2 days, we're drifting lower going into the close. The drifting lower got us almost down to that target we've been talking about. The minimum downside objective that we identified was 5,500. That's pretty much almost today's low. So, it is not lost on me that we've almost reached that downside target. When we get to the daily chart of the S&P 500, you'll see how I came up with that target, why that could be an important level, what sort of happens next if we would break down through those levels. And the short answer is you're going to need a new target, right? You gotta if we're going to continue to go lower, then we have to identify some potential further downside targets, which is kind of how this works. But for now, feels like the market has sort of played out as expected, given that initial downtrend going into our first line in the sand around 58.50. Now 5,500, basically a reality. So the S&P did close just about 55.21. That's down 1.4% from yesterday's close. So, honestly, not as bad of a down day as Monday, but not a good day. The NASDAQ composite down about 2%. We're getting just above 17,300 at today's close. Mid caps and small caps all underperforming the S&P. Small caps were down the most, about 1.75% for the S&P 600 small cap index, but the Nasdaq the worst performer. The Nasdaq Composite down about 2%. That's your big winner on the downside today. Volatility bouncing higher. Yesterday the VIX came down a bit. Today popping a bit higher. The VIX, almost half a point higher. We'll say to 24 and change. So we're right in the mid 20s, which means high volatility environment, which means elevated uncertainty. And similar to other measures of market instability, we're in one of those, we're probably in a pullback and or a correction type of range. That's about where we usually sit at this point. Looking at the fixed income markets, bonds moving higher. So again, this theme of weaker stocks, stronger bonds has been kind of the story here over the last month. And today, just much more of that. Yet we talked earlier in the week after Monday's sell-off, Tuesday, Wednesday, kind of that counter trend bounce. Today, sort of back to the normal trajectory, the normal theme we've been observing over the last month. The TLT was up about 0.9%. Bond yields all moving lower. The 10-year yield now back below 4.3%. 5-year point holding just above 4%. And the long bond yields right around 4.6%. The dollar index, not much of a change, up slightly from yesterday. But generally, the trend in the dollar has been weaker over the last month, but really year to date has been a weaker dollar environment. Looking at the commodity space, we had a couple of commodity-oriented charts yesterday that we talked through. Today, I will tell you gold and silver, the precious metal trade sort of waking right back up and continuing higher. The GLD closed just above 275. That's almost 2% higher. About the same for silver. Copper prices moving higher as well. Crude oil prices moving lower. So the energy side of the commodity space drifting to the downside. Generally speaking, cryptocurrencies really moving in line with equities. Bitcoin down about 4% today. Around 80,500 as we record the episode. Big round numbers I've just learned are usually important. So we expect at least short-term bounces off of a level like 80,000 or 90,000. So that's something that's on my mind as we're watching here. Again, a far cry down from 108,000. And cryptocurrencies, as I've mentioned a number of times recently, are sort of trading like a leverage play on risk, a leverage play on equities, or leverage play on speculation. They're sort of like a more volatile version of the S&P or the Nasdaq, and that's kind of given the structure of cryptocurrencies and the general participants that I think are, it's sort of a area of the markets ripe for speculation, arguably ripe for technical analysis. So I'm not surprised that they're sort of thrown around leverage moves in a similar direction to what we see in the equity markets. Looking at the 11 S&P sectors earlier, as I was preparing for the show, it looked like all 11 of these were in the red. Utilities did end up finishing slightly higher. The utilities sector, XLU, the only one finishing in the green, up about 0.25%. Materials, number 2, just slightly below yesterday's close. We'll call that a neutral day. Consumer staples, number 3, down about 0.5%. Healthcare financials, right around that same down 0.5% level. On the bottom, we've got some Mag 7 types of sectors. Consumer discretionary, your worst performer, down 2.5%. Communication services, number 2, down 2.1%. Real estate and technology, essentially tied for third from the bottom, both down about 2% for the day here. Let's see, what else can I tell you? The breadth back to negative, and this is something I was talking with Doug Ramsey a little earlier. We're talking about all the things that had changed, just kind of talking through the market top that we've now experienced from November through December, January, February, and now into March. And just talking about the signs that we tracked along the way and comparing notes, because Doug is, very proficient in technical analysis and definitely speaks my language along those lines, but also is is much more quantitatively oriented, much more fundamentally oriented. So thinks about all of these different disciplines and how they relate. But one of the things we definitely talked about was the change in breadth conditions. The breadth essentially negative across the board here. When you look at the daily advancer decliners reading, about a 3-to-1 sort of relationship between stocks down versus stocks up today, which again means about a quarter of the S&P actually finished up today. So those are always names that I'm interested in understanding, what was not down and why, right? What are those themes that are bucking this sort of distribution trend that we've been observing in the major markets. But also remember that most stocks are down. So this is not, someone actually wrote yesterday. I read an article. I won't name who it was, but I read it on a website. Is how I say it, and someone sort of mentioned it's been a narrow decline. That is not a way I would describe this particular market. Right, early days when Microsoft is coming down, and Meta is still trading higher, and going into February, and a lot of things are still making new highs. There, I could see you making an argument for there is a small number of stocks that are no longer participating. But any breadth indicators I'm looking at now, it's a broad decline. I mean, it is most things going down, most things below their 200-day. On a day like today, most things down versus up. I'm seeing there's nothing I would describe as narrow about what we've observed between mid-February to mid-March, and maybe that's where things have changed quite a bit. I think in the last 4 weeks. What else? Let's go to the Magnificent Seven and friends here. The mega cap growth stocks. Nvidia actually flat for the day, so that's interesting, right? So again, something that's flat means it was not down today, and that's almost like a positive day, relatively speaking. Microsoft down less than the market. Everything else got beaten down pretty good and underperformed the S&P. Meta, your worst performer. We haven't seen Meta at the bottom of the list for a while here. Meta making a new 6-week low, actually like an 8-week low, closing back below 600. Apple, which has not been a particularly strong chart, Apple and Tesla have been two notable, and Microsoft, probably the weakest of this group of stocks, down over 3% today. Netflix down over 3%. Tesla right at that minus 3% level. So don't get me wrong. I mean, growth stocks are certainly struggling, and in most ways more than value. But again, I'm seeing broad decline. That is definitely the way I would describe this particular market environment. All right, we're going to go to the market carpet, the heat map. I do see some comments and questions coming in on a number of different platforms. We are live streaming currently on Facebook, LinkedIn, YouTube, and X. Can't tell you how much I appreciate you guys tuning in live. We're about 6 months into this new show called Chart This with Dave Keller. And I'm so thankful that we are at this point. I am optimistically thankful about many awesome, successful points we will reach further on. So I appreciate anyone you tell about the show, anyone that you can get to follow the show and be a part of this discussion that we're doing every day. I'm a fan of that for sure. I can't see the questions that are coming in. We'll take a question or two before the end of the day. And then anything we don't get to, we are planning an all mailbag episode tomorrow. I've already had some really thoughtful questions so far this week. So I think it's going to be a lot of fun digging through some of them in a little more detail. But please keep them coming. We can always use a couple more questions here. All right. As we're looking at the market the market carpet, this is a heat map style visualization looking at the 500 S&P members on one page. And as I mentioned, the value of looking at a visualization like this, what I love about this is something that 30 years ago, investors couldn't do, right? They just didn't have the capability or the computing power or the digital displays to be able to look at something like this and even just see what it would look like. So I love, while I love a lot of the toolkit that I use, like trend lines and other techniques that, I mean, honestly have been, done by hand way before they were digitized, tools like this, things like the RRG and others really are only possible or at least practical in the modern age of what we're able to do. And so I love being able to reinvent the world of technical analysis using, digitalization and using AI and all these other things. When people ask me, is AI threaten what we're doing with something like this? I mean, I don't think so. I think it's going to make what we do even better and more interesting and easier to do, more efficient. I don't have a problem with that. It's a lot of work to do things like this sometimes. Having said that, let's look at the heat map and see what we can draw away. I'm immediately drawn to the big cluster of red, kind of middle bottom of the heat map today. Right in the middle, that's the consumer discretionary sector. You can see Amazon, Tesla, and Home Depot. Those three stocks make up about 50% of the XLY. So those are the three biggest names. And if you're looking at the chart of the XLY, you really are looking at Amazon, Tesla, Home Depot, and then a bunch of other things. Is kind of how you need to think of it. Similar to communication services, you're looking at Alphabet and Meta and a little bit of Netflix, and then a bunch of other things. And many sectors, especially the growth sectors, have that top-heavy nature to them, just because of how big those mega cap names have gotten in the last couple of years. So having said that, you know XLI is going to be struggling today. You know the XLC is going to be struggling with Alphabet, Meta, and Netflix. Those three biggest weights all down, 3 to 5% essentially, 2.5 to 5%, we'll call it. So I mean that was a pretty bad. And within consumer discretionary, which is actually a fairly diverse sector. I mean, there are a bunch of different things. Big internet companies, there's automakers, there's restaurants, beverage companies, all sorts of luxury retail, travel and tourism, home builders. I mean, it's like this mishmash of a bunch of different types of things. It's pretty much all down today, right? So I mean, a very diverse sector looks very not diverse when you're looking at the movements today. AutoZone jumps out. I actually did. Where did I even write that? I think that was on Stock Charts. I wrote an article for Stock Charts last night where we talked about AutoZone. I think that's right. Down slightly today after pulling back earlier this week, but overall, I mean, coming off of a new all-time high, in the last 5 trading days, still not a bad chart. And at a time when very few stocks are doing that, I think that's noteworthy. But again, average chart not looking particularly good. Within technology, obviously Apple struggling, Microsoft not good either, Nvidia, basically not going down. That's I guess impressive. Intel, the big one, right? I mean, gapping higher, up about 15%. That's, I think, the top performer in the S&P, and if not, it's got to be right there. But certainly diverging from the rest of technology. We'll look at that chart. I actually did grab that chart to talk about. I mean, it's not my favorite chart in history, but it really is a good example of a stock bouncing off of consistent support a number of times here. So something to think about. The financial sector is so important, and a number of the guests that I've had on recently on the podcast, we've talked about the financial sector. I remember digging into it with Jay Woods a couple weeks ago. I remember talking earlier today with Doug Ramsey about financials. I mean, they were so dominant there for a little bit of time, and still a question mark. My conversation with Doug still very constructive on the banks and financials, on insurance companies in particular. We focused in on Berkshire Hathaway, which I do own personally. That's one of the few individual stocks that I own pretty much as a long-term holding, bouncing higher. And again, charts like that are still in a positive, in a constructive technical pattern. The exchanges like SIBO and others. What's the other one I was going to look? It's not Market Access. SIBO. S&P Global, maybe I was thinking. I forget which chart. CME was another one that I was thinking. I mean, these are charts that are just in these nice, consistent uptrend phases. So charts that are in uptrends generally are good things to want to own, right? Or want to be interested in because they're going up, right? I mean, that's the point of trend following and technical analysis, is find things that start to go up and hold them as they continue to go higher. But particularly in this kind of environment, when most things are not going up anymore, or at least have either pulled back or in a big time downtrend, something like CME Group totally stands out, in my opinion, as an outlier with a very strong chart. Within communication services, and again, I'm drawn to the old telecom stocks still. They've chopped around here a little bit, certainly in the last week, and names like Verizon have pulled back very quickly. But I would say still, I mean, with pretty constructive technical profiles, strong dividend components, which I think goes a long way. Other things I'm looking at, aerospace and defense. Which I think, given the headlines that we've seen about the elevated conflicts and just uncertainty surrounding global conflicts, you're certainly seeing defense names. Raytheon is one I think I grabbed for the chart review portion to review. I mean, names like Costco not doing well anymore, and I think those are some of the toughest charts to deal with, to be honest with you, because we did a series of videos called. We call it Chart of the Month on Stock Charts TV. And I have talked with Grayson Rose, by the way, about reigniting that. I've done that randomly on my own YouTube channel on that you may have seen, but talked with Grayson about sort of restarting that monthly exercise that we did. Hopefully we can get that going here in the next month or two. But Costco was one I think I included on at least 3 of them in the last year. I remember it was just this great stock to keep going to, this great long-term uptrend. But these are uptrends that are now, I mean, no longer an uptrend. I don't think you can define the chart of Costco as in a primary uptrend. It's at worst the beginning of a big deterioration. At best, I think it's a significant pullback. but questionable. And so I don't think you can describe that as a particularly strong chart anymore. And that's changed just from mid-February to mid-March. And I think that's what has evolved so quickly is now before, right, into mid-February, the S&P and the NASDAQ obviously making new highs, and the S&P in particular, but a lot of individual names looking good, right? So Costco didn't look that vulnerable. It looks just really strong. In the last month, Costco does not look strong anymore. And I think that sort of tells you how this market has evolved. I mean, as always, we don't want to spend any more time with this, but I would just tell you, I mean, generally speaking, my suggestion is focus in on areas of the market showing strength despite market weakness, right? Intel popping higher, there might be something there because it's going up when most things are not. AT&T and Verizon continuing to have positive gains. Some of those banks, financials, exchanges continuing higher. Defense names. These are charts that actually still look quite good despite the fact that the markets are struggling. And utilities, I mean, final comment, utilities, right? Bright green. And some of these are still in strong uptrends. Some of them have pulled back quite a bit. A lot of these pay a pretty strong dividend component. And I think that's what's most important to look for right about now. All right, getting to the chart review portion of the day here. So here's the S&P 500. Here's our daily chart. You can see the Fibonacci retracements we have taken from the August 24 low to the December 24 high. Why don't I use that high and why do you use this one? This is where Fibonacci retracements are a little more of an art than a science, same with trend lines. I always would tell my students at Brandeis University, where I taught technical analysis to master's students for a number of years, I'd always, oftentimes pass out a chart and ask them to draw the trend lines. This is after we learned about trend lines and all that. And then we'd start showing them. I had people come up and share their work, and we found how many different trend lines people had focused on. And again, part of that was just to illustrate the fact that, there are some automated trend line tools, but they're not particularly helpful in my opinion, because it's a very subjective form of analysis. For me, it's sort of a conversation you're having with the chart to sort of represent directional moves, to sort of identify trends and themes that you see. So that was a long-winded introduction of the way of saying, why do I use that high and not that high? Because I see that December peak as like the peak. And then I would say, when you look at what's happened in January, in late January, early February, mid-February, I would say those are all failed attempts to get to a new high. So I think the market looked a certain way going into December. I think it looked a very different way over the next 2 to 3 months. And now all of a sudden, this looks more like a distribution phase. You have an accumulation phase, a consolidation phase, a basing pattern, which was resolved to the downside. And I think that's brings you to where we're at now. So now that we've broken through 5850, broken through the 200-day, what's the next downside objective? 5500 is what we've been talking about. We're basically there as of today. That is based in part ways based on the Fibonacci retracements you're seeing here. That represents a 61.8 retracement back down to the August low. Which means two things. Number one, we're oversold, reaching a key potential support level. I would expect at least some sort of bounce to be happening here probably pretty soon would be my guess. If we do see a bounce, I would assume that is a short-lived bounce. I wouldn't be surprised if we have a nice run higher. And I think the way that I think of this now is we're guilty until proven innocent, which means bounces up to the 200-day, even bounces all the way up to 5850 by my read would still be a bearish structure and most likely putting in a lower high. We'll see how things actually play out. But I would say breaking below 5,500, then all of a sudden you need to, think about further declines. What I would probably do at that point is do a much longer term chart. Look at the last major low. Go back to like the 23 low, right? That September, October 23 really major low that set the stage for strength into the end of that year, all through 24, and really into February of 2025. Take that entire uptrend and start to measure some longer term levels. I have done that, and it gets you down. I'm not going to pull it out of nowhere. I'll probably work it up for the show tomorrow or Monday or something like that. We'll see when we break 5,500. But I mean, it's at least probably down at 5,100, which would be the August low. Might even be further than that. That would probably be like a 38.2% retracement. I'll have to look at the charts and dig into it. But for now, this is the objective we talk about. This is where we're looking. We're oversold as we reach there. Counter trend bounces make sense. Do I do anything in particular to play that? I don't. But my goal is not trying to swing trade this kind of environment. If I was a swing trader, would I take maybe a short position or a quick long position, sort of betting on a mean reversion, I'd be tempted to do something like that. And I would say from a technical perspective, you could justify that. But I'm more concerned with the longer term evolution from uptrend phase to downtrend phase. And I think that's the issue. Monthly chart of the New York Composite Index. I actually have this toward the end of my market misbehavior live chart list. And by the way, you can access some of the charts we show here, including my daily S&P chart and a bunch of others. Go to marketmisbehavior.com/charts. You can get to that chart list on the Stock Charts platform. I keep it updated regularly, so you can save that URL and come back to it and see what the charts are telling you. But this is one that I have on the end of the list. And I have it really for the Kopic curve, which is not particularly helpful in this environment. It's really more designed for a long-term decline. When you have a cyclical downtrend, right, a cyclical bear market, and you're looking for that sign that the bottom is in, the Kopic curve, which is this bottom indicator, is what's so helpful. And literally, it's a monthly indicator. You look for it to slope higher. And so I've highlighted with green vertical lines those signals going back every month. And as you can see, it's pretty good. It usually happens pretty soon after a major low, and it tells you we're probably going to go up a lot more after that. And it's usually, I've learned, something you don't want to ignore and make sure that you're invested at that point. And I was often asked about what's sort of the opposite of the Kopic curve. What would tell you that we're overheated on the upside and probably turning lower? Because you don't use the opposite of the Kopic curve, although it does look kind of interesting at times. And I'm wondering maybe that's something to dig into a little further, but not really what it's designed for. So two things come to mind. Number one would be the Hindenburg Omen, which we do follow. And we shared, December was the last signal right before the end of the year. Ended up being a pretty decent, predictor of the trouble that we're seeing from a technical perspective in the first quarter of this year. The other thing would be the monthly MACD or the monthly PPO, and that's why I actually have it on this chart. Literally looking for the classic sell signals, which would be the PPO line crosses down through the red signal line. The last sell signal we got there was in January, February of 2022. Not a bad indication that was over. Before that, we have a signal here in early 2018. Not a bad indication of some weakness there. Before that, sort of mid, we'll call it third quarter of 2014, maybe around September. Pretty good indication that things were rolling over. And, boy, we're really, really close. Didn't quite do it at the end of February, but very close at the monthly close. You have to wait for the monthly close to confirm what the level is going to be, but very, very close to getting, the fifth sell signal since the financial crisis. That's a signal I'll be looking for. And again, this is a very long-term chart. It's a monthly chart. So these are big moves that I'm summarizing in a very long-term chart, but something to pay attention to. That one of the things I see is sort of the contrary version of the Kopic indicator, which is good about buy signals. Something that's good for sell signals, very close to triggering here. We'll see what happens at the end of the month. We've included this chart most days here just to highlight what's happened, and you can see that as the S&P has broken below its 200-day moving average, a lot of individual stocks have had the same issue. We're down about a third of the S&P still remaining above their 200-day moving average, down around 36% as of today's close. In terms of how many stocks are above their 50-day moving average, it's down to below 30% here. This one is more of a short-term breadth indicator. This is more of a long-term breadth indicator. One of the many things that has concerned me in the last couple of weeks, as I've described to you, the S&P not holding its 200-day, the NASDAQ not holding its 200-day, that's an issue. Less than 50% of S&P stocks holding their 50-day, their 200-day moving average. That's a concerning development as well. And we haven't seen that particular condition since November of 2023. We haven't seen a sell signal like that or a bearish rotation since September of 2023. So generally, again, this sort of fits into that distribution move. Now, at some point, there's so few stocks above their moving averages that it suggests more of a contrarian buy signal that so many things are down. We're not there yet based on my use of that indicator. One interesting development, though, is the NASDAQ 100's bullish percent index. The bullish percent index, I didn't talk about it for a little while because it's really only valuable at extremes. I found these bullish percent indexes are really valuable when you have the extreme bullish or extreme bearish signals. In the middle, I think it's more noise than anything. So it's worth noting that the NASDAQ 100's bullish percent index just broke below 30% here over the last 24 hours. And that is a far cry from 70%, which was the number that we had about 4 weeks ago. So what does that mean? That it's gone from 70% to 30% in 1 month. So this is looking at the 100 members of the NASDAQ 100 and looking at all their point and figure charts. Is the most recent signal a buy signal or a sell signal using the traditional point and figure methodology? And back here, about a month ago, 70% of the NASDAQ 100 charts were in a bullish configuration. Now, 40% of those names have given a sell signal just in the last month. And so again, that shows you the rotation we've seen, particularly in the growth space here. Now, if you look back to the left, when this indicator gets below 30%, that confirms we're in a downtrend, but breaking back above the 30% level is often a really compelling buy signal. It certainly worked in the last couple observations. And so something to keep an eye on if we do get that trigger. I would also note this one. I actually wrote about the S&P 500's bullish percent index on CNBC Pro earlier today. So if you follow my work there, you can check it out in a little more detail. But this one not quite down to 30%. I've highlighted with some of these vertical lines what has happened. Similar idea when we've gone below 30% and popped back up. It's usually a pretty good sign for stocks. But again, that means there's more room to go. And I think that's the problem with these indicators is they're not telling you we're at a bottom yet. They're telling you we're getting near to the point where we can start to think about a bottom, but it's not there, right? And so I think there's more downside probably to be had with both of those charts. Bond markets overall popping higher today, and this is after drifting lower over the last couple of days. I'm seeing this. It's not really a triangle pattern, and it's probably misleading to have these two on here because it makes it look like I'm showing this consolidation. I think there's a couple of things that are all happening here. I'm seeing this as a potential inverted head and shoulders bottoming pattern. That would only be valid if and when we would break above this pink trend line, which is why I have it on here. And I'm also tracking the trend line off the lows. So I think that's where you could pull back in terms of bond prices and still be in a very clear uptrend swing from the mid-January low. I think we're in clearly a reversal pattern from distribution to accumulation for bonds. I think, generally we see bond prices, continue higher from here. I think that would be a big confirmation that thesis is correct. That also means interest rates probably coming down here for the foreseeable future. All right, looking at Alphabet, and again, I'm not going to show all the FANG stocks, but again, if I do write a book about the great top of 24 to 25, one of the charts we'll probably include would be Alphabet, particularly to talk about divergences, talk about blow off tops, gaps and falls, right? Gaps that just continue lower, no buyers coming in. I mean, it just really has all the markings of a major topping pattern. But what's happened since then is a real issue because instead of just making a higher low and continuing higher, we've broken the 200-day. We then tested it from below. Now we have another gap and further deterioration. So I mean, charts like Alphabet, I think, are in full distribution mode here. I think the primary trend is down until proven otherwise. Home Depot and other consumer discretionary names struggling as well. I've drawn this series of, or just this neckline to confirm the fact that that's a pretty good example of a head and shoulders topping pattern, even bouncing off the neckline and then finally breaking it. And the neckline and the 200-day were almost exactly at the same point when we broke. So it was a perfect example of that pattern. If you take the height of the pattern, which is just over 13%, subtract that from the breakdown level, that gives you a minimum downside objective right around 328, we'll call it. And I've highlighted with the shaded area how well that lines up generally with sort of that spring, early summer low from 2024. So that implies that there's more downside to be had. But when Home Depot kind of gets down in that 320 to 330 range, that's when you could, start to assume we get some sort of bounce higher. Maybe that is the end of this drop because that would mean, basically the head and shoulders objective has been met. We've hit major support. But again, we're not there yet. And so I think that's why I'm not sort of saying this is an obvious point where things bounce. This feels like an obvious point where things probably go down further until proven otherwise. Now, to be clear, not everything is going down. And as a matter of fact, some things are actually going up. Intel is one that's bouncing higher. I mean, really bucking the trend of the other semiconductors, bucking the trend today from the rest of technology, which we're all getting hit pretty good today. Intel actually bouncing higher, about a 15% gain today. Now, what's interesting is I would argue the action that's happened going into today's session, because we see a major low around 19 to 20. We saw that in August of last year, September of last year, December, January, early February, early March. all right around that same level. So, I mean, really, from a technical perspective, you can see an incredibly valuable level of support that has been met and tested and confirmed many, many times over. So, betting on bounces from that level make a ton of sense to me. The question is, how much of a recovery really tells you that this is a different pattern? Things that I look for: higher lows, breaking above moving averages, breaking above resistance, the moving average sloping higher. Some of those things have happened. For example, a bit of a higher low and a gap higher. That's good. We traded up to the 200-day, but did not quite close above it. Last time we closed above it, it was very short-lived, and we came right back below. So getting above the 200-day and holding it, getting above 26, which would clear that resistance from November and from February, the 200-day moving average finally sloping higher. Those would be the things that would tell me Intel is now exiting this consolidation phase, right? So we have a distribution phase of lower lows and lower highs, a consolidation phase where a basing pattern of consistent highs and consistent lows. Now you're looking for the accumulation phase, higher highs, higher lows. Break above 26 would probably complete that rotation. Until then, not there. And I'm setting an alert for that breakout. Final chart. Oh no, two more charts, and then I'll take some questions. I was looking for things that were actually going up. I immediately thought of gold. Sure enough, making a new all-time high today for the IAU. Full disclosure, I do own IAU in my own portfolios, but I've owned gold and/or gold stocks for a while now, through all of 2024, and I've added to it over time because it's done so well. And has even outperformed, other equity markets, right? I mean, look at the IAU in 2025, absolutely crushing the S&P and the NASDAQ. It looks more like a non-US, it looks more like Germany or the UK, to be honest with you. There's a lot of things to like here. Again, at a time when so many things are breaking down, and at a time when only less than half of the S&P members are above their 200-day moving average. Looking for things above upward sloping 50-day and 200-day moving averages is pretty awesome. And sorry, I can't multitask, but I am writing a scan note because there's a scan I wanted to try. Depending on what happens, I might share it with you here very soon. All right, that's a good chart. Again, I just don't see anything on the chart of gold implying anything, but it's in an uptrend. And so charts like this, innocent until proven guilty, in my humble opinion. Defense stocks doing quite well. There's obviously a sort of macro non-technical reason as to why that's happening. Added instability, expectation that we may have additional spending on defense versus other areas of the federal government's budget. Potential issues in around the world that would require additional defense spending. All of these is helping to propel these stocks higher. RTX is making a pattern of higher highs and higher lows. So, I think, again, charts like this, above moving averages, momentum strong, not excessive, relative strength is improving. Those are the types of charts I'm often looking for. And I think with defense stocks like RTX, you're seeing it happen here today. All right, those are the charts I had prepared. Let me see what sort of questions I saw going through rapid fire. I could take, it was a whole conversation happening, which is awesome. Let's see what we can do. Larry, thanks for watching on YouTube and sharing a market history fun fact that you had me at that moment. You captured my attention. CNBC reported today this decline in the S&P and NASDAQ is the 5th fastest in history. That's interesting. I'm not too surprised. Just given the trajectory of it, what I found a lot of times is in traditional financial media, by the way, they love to measure things in point value. So they'll always say like it's the biggest gain in the history of the S&P. But in terms of points, we're just up in the 5,000. So smaller moves seem like bigger moves when you measure them in terms of actual value. So, the S&P being down, 200 points really doesn't mean a whole lot. The percentage differences are what are so meaningful. So assuming they're using percentages, I guess I buy that. That makes sense. It's certainly been a compressed time frame for sure. Surpassed only in recent times by the Great Recession and 2020 COVID collapse. Yeah, it has very similar feels to that. Again, one of the things I tell, people when I'm presenting about the markets is, and just presenting about what we do, is that I think the benefit you get for doing what we do for so long, and I've been doing it 25 years this year, and hopefully for many, 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 many years going forward. But I mean, I think the one thing you gain from doing this a lot is you just have experienced different bull and bear cycles, right? You've experienced market tops, and it's not just you read a book about it and what happened in 2000. Like you lived it, and you saw what was happening, and you heard what people are talking about. You heard people that fought it, you heard people that embraced it, and all of those things helps you the next time you hear those similar buzzes and your ears ring, because it's like, ooh, that sounds very similar. And I think the reality, and this is something I talked with Doug Ramsey today earlier, and we'll have that episode out for you probably tomorrow morning, time permitting, was the fact that the run higher, I mean, the severity of the pullback, I mean, I would agree to your point. I mean, there are a lot of things that could have caused, a significant and very quick move. Structurally, right? I mean, I think there's a couple things structurally. You'd mentioned in another comment, algo trading, for sure. I mean, I think more than ever, you have models that are tracking movements and are trained to get away from markets that start to pop lower. I would argue what that's doing is basically compressing time. So things that may have taken a little longer to do are actually happening a lot more quickly. I think that's a fair assumption about part of it. I would say this decline is also not as much about the decline. It's also about all this other stuff that happened just before the decline, right? So, I mean, a decline like this, I think only happens after you've had the significant uptrend that you've had. I mean, you alluded to, it's the biggest pullbacks that we've seen from a high since 2008. I mean, think about all of the euphoria that was priced into the market in 2006 and 2007 before the top hit. I mean, it was pretty euphoric. Think about going into the COVID peak. There's a lot of optimism. There's a big uptrend that happened going into that peak. We often just think about the negativity of the COVID announcements and the reality. But I mean, the market was just ripping higher before then, and arguably we saw. I mean, the significance of the trend before the decline is one of the things. It sort of sets the stage for it. And if you want to learn more about what I just said, kind of like the classic theory of bubbles and bubbles popping and quick declines, manias, panics, and crashes, classic book by Kindleberger. That's on my recommended reading list, marketmisbehavior.com/reading list. Or just go to my website and click on the link on the top. That's a great market history book. And Irrational Exuberance is another one that really talks about that sort of a psychological issue. What else? Tony, thanks as always for watching, my friend, fellow Pacific Northwesterner. You said about scooter rankings, is there a good range, for example, 90 to 95 rather than 99? Yeah, I've had that kind of question before, and I really appreciate that question, Tony. With scooter rankings, so scooter rankings are the stock charts technical ranking, and you can see that in a couple places on stock charts. This is proprietary to the stock charts platform. But the formulas are readily available. You can access them on the website. But basically, Apple right now has a scooter ranking, a stock charts technical ranking of 26. This is a percentile ranking, looking all of the large cap stocks in that universe, U.S. stocks, U.S. listed stocks, and basically puts them in order based on trend characteristics, multiple time frames weighted a certain way to come up with one score, and then a percentile ranks that entire universe from strongest to weakest. So 26 basically means you're in the 26th percentile, 99th percentile would be the best, and on down. You can see it there. You can actually put an indicator that shows the scooter ranking. You can also go up here, and they have a scooter report, which are actually updated real time during the day. But this is the current scooter report, intraday updated for the large cap universe. You can see XPEV, which is a Chinese automaker, the top one. AppLovin is number 2, and so this is one of those, right? It's 99th percentile, but it's come down so much so quickly, right? I mean, it's been cut in half. This is one of the challenges with the scooter ranking, is because of the weightings. If something really rips suddenly up or down, a lot of times it won't be picked up with the ranking just yet, which is why I would never say just buy the top 10 stocks. That is not an approach I would personally use, because you will find there are better ways to find strong performing stocks. So, is there a good strategy? I mean, no, my general way of using the scooter rankings, if I want to focus on charts that have relatively constructive trend characteristics, I'll look for a scooter ranking above 80%. That's actually a scan I will often run, is stocks in a particular sector with a scooter ranking over 90. a scooter ranking over 80, something like that. That issue that you mentioned is true with some indicators. I've not seen as much of the scooter ranking, but indicators like RSI, things with like the highest or lowest RSI are often these crazy outliers that are so extreme. So what a lot of people do is ignore like the very first couple names and jump down to some of the other names. And I get that. With scooter rankings, I don't think it's as helpful. Personally, what I found is the scooter rankings are really good, but in periods of transition, there's a lag between when the trends will change enough that the rankings will score. So like right now, some of these names are still really good. Like you can see ESLT making a new 52-week high today, XPeng making a new 52-week high this week, Goldfields making a new high, Alibaba not too far. But then you have something like Rocket Lab USA that's gotten absolutely crushed. So I think for me, it's a good starting point. It's not an ending point, which is why I never just say, just buy the top ranked names. I don't think it's helpful for that. It helps point you to things that you want to dig into further, but then go through the due diligence and analyzing the charts as you can. Folks, that will do it for today. Thanks for a couple really interesting questions. I appreciate it. Made me think a little bit. And I can't thank you enough for that. The questions we did not get to, we will definitely put it in the Chart This mailbag. We'll do an all mailbag episode tomorrow. We'll do a brief market, commentary, and then get to some of the thoughtful questions you guys have shared. So thank you, all of you tuning in live on these different platforms. Thank you, those of you asking questions and keeping the discussion interactive. And thank you, those watching it on a replay on our YouTube channel. Lots more great content to come. But for now, I will say have a fantastic night. And remember, it's always a good time to own good charts. Have a good night, folks.